Hello and good morning, ladies and gentlemen. This is Shikhar Garg, your host, bringing right here for you Almus Market Mornings, your daily dose of financial updates. Now, overnight actions suggest market participants are expecting Fed to be quite aggressive with the quantitative tightening and rate hikes, which is also supported by one of the Fed governor's statement, Mr. Brainard's statement on the sort of rate hikes and QT expected. Now, oil also dipped as well as the geopolitical tensions does not look like it is ending. So, JK, what do you think of Fed and its actions with respect to inflation and the heating economy, as well as the geopolitics? Because we see all of these, pointers are making dollar index rally, whereas the majors are just giving it up. So, JK, please tell us.
Hi, good morning. So, markets had a good recovery rally in the last few weeks, and it halted in its tracks when Fed members started making very hawkish statements. And yesterday we saw the Dow lose nearly 1% and Nasdaq lose more than 2%. After Brainard said that Fed will quickly ramp up its reductions to the $9 trillion balance sheet considerably, and with more rapid pace of rate hikes that will be done in the coming months to rein in the inflation. So the balance sheet shrinkage combined with a series of Fed rate hikes will contribute to monetary tightening in a very short span of time, and this will be well above the expected increases that has been reflected in the market pricing and committee's summary of economic projections. That's what she said. She even said that labor market was extremely tight. Balance sheet reduction will possibly start next month, and Fed projections do not show a lot of overshooting on the rates. Now, we also had another member who said that not high inflation was as bad as not having a job. So that is the kind of seriousness that they are putting on the current inflation rate, and the actions that they are proposing to take. So no wonder the stocks just got halted in their rally and fell. In fact, they were doing well into the European session, but it was it was fully reversed later. In effect, stocks. Apart from stocks that fell, yields also rallied. 10-year was up at 2.549. 2-year at was also well about 2.5, and the yield curve inversion that we had seen in the last few days got reversed actually. So we are actually now in the steepening side. Not, I mean, steepening would be a hard word, but then it has definitely come into the positive side. Apart from this, the Euro executives have proposed new sanctions against Russia, including a ban on coal imports, as the West responds to evidence of civilian killings in a Ukrainian town, which has been seized from the Russian invaders. So the proposed sanctions would bar Russian imports worth 9 billion euros and exports to Russia worth 10 billion euros, including semiconductors and computers, and would stop Russia ships entering the EU port. So it's not just the hawkish Fed member statements, but also the geopolitics and the economic war, which is continuing, putting the markets on on a downward path, both in terms of treasuries and the stocks. Added to this, today morning we had a massive drop in PMI services in China from 50.2 to 42, and this also has some it's also because of the rise in the corona cases in China in the recent days, but definitely market has not taken it well, and we saw the Chinese one hit 6.3850 in early trades today morning. So dollar, of course, euro's weakness along with the yen has contributed to dollar index moving into a new high in the cycle, and probably now it will target psychological level of 100. And on the charts, 100.84 is what I am seeing as the target. This is despite the fact that dollar is structurally remaining overbought, but short-term players are preferring to be in the dollar because of the yield attraction and safe haven buying as risk assets get sold off. Rupee had a good run in the last 2 days, or rather the beginning of the new financial year, with the bunched up flows. In fact, exporters came into the fray to sell after the rate dropped below 75.50 yesterday. And but these developments in global markets should rein in the dollar, and we should see the rate moving above 75.50 again. 75.80 of 80 and 76, these are resistances, but definitely we might see some short covering in the market. Yesterday's fall through 75.30 was also something to do with rumors in the market that government may go in for LIC IPO in the month of May, but no real confirmation except one of the news reports. And so we will see. Currently, focus is on how the global markets pan out, geopolitical developments, and we also have Fed meeting minutes, which is to be published today. Then we have Friday, the RBI policy to be announced. All in all, we have volatility springing back in the new financial year, and we should see good two-way movement in the currencies, because as far as the dollar is concerned, we are at the highs. At the same time, there is no reason for us to think that dollar should drop even though it is at the high. So there will be a two-way approach to the market, which will keep volatility at high level. Thank you.
Okay, so that's what we hear. Nasdaq and S&P went down with the update of 9 trillion worth of reduction, or the QT coming up along with the rate hike. Now, this is a deadly combination to come up with, and investors do fret such kind of an updates. At the same time, yes, we do see Euro bringing in sanctions. So it does not look like the geopolitical tensions are subsiding anytime soon. In one of our commentaries, we did mention that these updates or the influence of geopolitical war is not just temporary, it is something on the longer term front. And to support that, we now hear Japanese government starting to increase their spending on defense budgets. Now, this is the kind of increase or reallocation of budgets which Mr. Yuval Noah Harari was talking about. So geopolitical tensions never do good, and this is what we are observing for Indian markets. RBI policy is coming up. Let's gear for something good. Till then, please manage your risk well. We see you again tomorrow. That's it for today. Thank you.